Financial Accounting, Chapter 7, Internal Control and Cash, Part 1 of 2. This chapter, we're only going to have 2 slides. There's a lot of, I guess we could call it definitions and concepts in this chapter, but not quite as much of the quantitative analysis that we've done in prior chapters. So it's assumed as we start Chapter 7 that students understand financial statements, how to prepare them. Students understand the accounting process, the accounting statement formulas. Students understand issues related to classified financial statements, adjusting entries, closing entries. There needs to be an understanding about inventory and how inventory is maintained in a merchandising company, how a merchandising company has a different type of income statement. And it's also, as we've gone into a bit of details about the different options you have with inventory: FIFO, LIFO, weighted average, specific ID. Now remember that all of these rules are GAAP, generally accepted accounting principles. And these are the rules of accounting, just like any athletic sport has a specific set of rules. We have these rules in accounting. And these GAAP rules adhere to accrual accounting. And so that's what we've been talking about up to now. Chapter 7, we're going to start what is commonly known in the academic world as the march down the balance sheet. So we're going to start talking about cash. Then we'll go on to accounts receivable, and we'll look at plant, property, and equipment. But let's look at cash. And most importantly, we get to talk about one of my favorite topics, and that is internal controls, because it's related to auditing, which is one of the upper level accounting courses that I teach at the Citadel. It's one of the careers in accounting that many students enter, and auditing is something we really haven't talked about very much. So I'm going to give a quick rundown about what auditing is and what type of profession it is. So what does an auditor do? Well, these financial statements that are prepared for the large corporations that sell their stock publicly. We haven't really discussed much about this. The SEC, or the Securities and Exchange Commission, regulates the sale of stock to the public. Whether it's Snapchat, who recently went public, as they say, or a company like Coca-Cola, who has been a publicly held company for over 100 years. These companies are regulated by the SEC. The regulations are important because of the Great Depression. Quite frankly, if you go back to the 1930s, when the Great Depression occurred, it was because no one was regulating the financial statements, and individual investors were buying into companies that really had a lot of fraud, that weren't being honest on their financial statements, that didn't have internal controls to ensure that the financial statements were accurate. So what's the job of an auditor? An auditor is an independent person who is licensed as a CPA to come in and analyze the financial statements to ensure that they are accurate and that they adhere to GAAP. And only CPAs are allowed to do an audit, and an audit is required of every single publicly held company. And so whether it's Walmart or Coca-Cola or Snapchat, you can go to their websites, you can Google, for example, Apple annual report, and you can get the Apple Computer annual report, and you will find the report of the independent public accountant. It's generally one of the larger international firms. There are 4 of them: Deloitte, PricewaterhouseCoopers or PwC, Ernst & Young, and the other one is KPMG. There are lots of other large firms. There's BDO Seidman, Grant Thornton, and then there's lots of small-sized firms. In Charleston, there's a smaller-sized firm called Dixon Hughes. It's considered a regional firm. It's in several states in the United States. But those other 4 firms that I called out a minute ago are international, and they have offices everywhere from China to England, to Africa, to the United States, South America. And lots of students get wonderful job employment with these international firms. And what do these international firms do? One of the biggest jobs that they do is they do auditing. And another piece of that auditing is analyzing the internal controls of a company. So that's a little bit of background. As we've said, this is going to be broken into two parts, this chapter. So we've got first the Sarbanes-Oxley Act and internal controls in financial accounting. We're going to talk about internal controls a bit in this first half. And then the second half, we're going to do a little bit of quantification, looking at reconciling a bank account. So the Sarbanes-Oxley Act, 2002, was passed by Congress. Sometimes it's called SOX or SARBOX. And it only applies to publicly held companies, and the Securities and Exchange Commission, the SEC, mandates that all publicly held companies adhere to it. So Enron in 2002 was a very large billion-dollar company in Texas that wasn't adhering to the requirements of GAAP, and there was a lot of fraud found within that company. And quite frankly, the CPAs were also found to be at fault. There was a CPA firm called Arthur Andersen. And after the fall of Enron, after the United States Justice Department came in and found all of the fraud in Enron, then Enron went bankrupt, closed. If you Google Enron, you'll see a tremendous amount of information about it. There have been movies and books written about it and how fraudulent they were. And so to maintain public confidence, Senators Sarbanes and Senator Oxley introduced and passed the Sarbanes-Oxley Act. And this Sarbanes-Oxley Act relates to ensuring that the internal controls of a company are there. So we're going to talk about what these internal controls are. Okay, internal controls are procedures and processes to safeguard the assets of a company, whether those assets are cash or inventory, buildings, computers. Internal controls are there to ensure that information is processed accurately and to ensure that the laws and regulations are complied with. And these internal controls are over the recording of transactions in the financial statements to ensure that if you invest in shares of stock with anyone from Snapchat to Amazon to Walmart, or any of the other millions and millions of companies out there that you hear talked about on the business report in the evening, these internal controls are to ensure that the financial statements are correct and that there is no incorrect information, there hasn't been any fraud, and there hasn't been any corporate malfeasance, as it's called. Prior to the passage of Sarbanes-Oxley, it was considered that there were weak internal controls. And after the passage, fraud and theft has been not eliminated, but it has been much less prevalent, and it actually set some pretty strong standards in place, which says that the CEO of a company, the number one guy in the company, is going to be responsible if there's a problem within the company, because the CEO, the chief executive officer, should have controls in place, and it's his job to ensure that there are controls in place. Before Sarbanes-Oxley, Sarbanes-Oxley requires that independent accountants, these CPAs, file a report on their 10K to the SEC. So this is a lot of new information. Again, I hope everyone takes notes as I'm going through these PowerPoints. Completely up to you, but that's the best practices for retaining this information. A 10K is a report filed to the Securities and Exchange Commission that shows the financial statements and gives lots of information about the company and its segments and its international sales, its CEOs and its corporate executives and its board. If you Google annual report, what you'll really be looking at is this thing called a 10K, but kind of made a little bit prettier. Sometimes it's got nice pictures of the company. We use John Deere in a face-to-face class, and of course there's pictures of tractors and all the different products that John Deere has. But this report is filed with the SEC, and it is a report that the auditors analyze. Here's an example of eBay's report with the Sarbanes-Oxley. This is 2014, and it goes to the SEC, And it says management's responsible for establishing and maintaining adequate internal controls over financial reporting, and the management of eBay has determined that the internal controls were effective. And there's the word. Our internal controls over financial reporting were effective as of December 31st. You will find this wording on every publicly held company who sells their stock on the New York Stock Exchange or the NASDAQ or other public stock exchanges. It's a very stringent requirement, but ensures that these financial statements are accurate. So the objectives we've talked about, and we'll go into a little bit more detail, and that is that fraud is a serious thing. It's the intentional act of deception. It's also called corporate malfeasance, which means embezzlement, which could be stealing, or financial statement fraud, which is putting down false numbers. Now, interestingly enough, most people think embezzlement or stealing is the big one, but the bigger one is financial statement fraud. So yes, there is theft that goes on within a company. Cash theft, inventory theft. People steal everything from office supplies to computers, printers, office furniture. Hospitals have medication stolen. But the financial statement fraud is the big one. It goes into the billions of dollars. It's the corporate executives possibly trying to fake the numbers to cover up embezzlement. Sometimes they're fraudulently putting numbers in there so that their bonus will be bigger because it looks like the company made more money. Financial statement fraud is huge. In fact, that's what brought Enron down. But it's the intentional act of deception. Internal control has 5 elements, and we're going to talk about these 5 and how if you go to work as a CPA in a publicly held company, sorry, I misspoke. CPAs, you don't have to be a licensed CPA to do internal controls. You do to do the financial statement audits. But if you go work for a company, and lots of times it's called risk and assurance, you'll be analyzing the internal controls of the company. So here's the 5 components, and they affect management and the business as a whole. And it's the environment and the risk assessment, control activities, information, and monitoring. It's all under this environment umbrella, as we like to think about it. So what's the control environment? It's management's philosophy. It's the way management acts. It's management's personnel policies. It's the attitude of management. That's why management's responsible under Sarbanes-Oxley. It's whether or not employees are held to a code of ethics, if there are any conflict of interest policies set in place. Some of you have probably got good, strong examples that you can add to the discussion in this area, because lots of companies have job descriptions that prevent you from doing this or from doing that. There are codes of ethics that should be adhered to within a company. When individual employees are trained, they should be told what they can and cannot do. There are things to make sure that promotion is fair and just and not biased. And so the control environment is your overriding piece of internal controls. If you work for a company where upper management is cheating, it's a whole lot more likely that other people are going to be unfair and untruthful, and because of the attitude of management. The CEO sets the tone for the entire structure, and that should trickle down to employees and their policies, and it should come all the way around to management's philosophy and operating style. So once employees find that management is strict, employees have a tendency to be strict. If employees find that management is lax and lets a lot of things slide and says, oh, it doesn't matter, and gives a lot of exceptions, and oh, it's okay, don't worry about it, I know, you can go ahead and take that, it doesn't matter, or yeah, go ahead and take the afternoon off, and just fake your time card and show that you worked until 5, or if the CEO, you know, himself or herself does these kinds of things, then the environment is going to be one such that the strict controls aren't adhered to, and possibly corporate malfeasance could occur. Risk assessment is also known as ERM, Enterprise Risk Management. It's a full field of study where customers look at the risks such as customer requirements and threats and regulatory changes, and it all ties into profit. There is ERM in every type of organization, from a hospital to ensure that patient safety is adhered to the hugest threat that we have out there now, which is cybersecurity, because of all of the data that we've got floating around in the cloud, that it can be easily accessed and hacked into and inappropriately used. Control procedures are the procedures set in place to make sure that the business goals are achieved. Now here's a list under this umbrella. Notice we've got competent personnel. That's ensuring that you've got personnel that know what they're doing. Rotating duties to make sure that one person isn't so in charge of this one area that they have the ability to manipulate it in a fraudulent way. Mandatory vacations. Students love to try to figure out what the heck does that mean, mandatory vacations. So if you've got an employee that won't take a vacation, that says, oh no, I don't need this vacation, there's a possibility that they have such strict control in the area that they're working in that they're scared that if they leave, someone else will find out what they're doing that's inappropriate. So you want to make sure that your employees take vacations. Separate duties related to operations, custody of assets, and accounting. That's a huge one that we have talked about before, separation of duties, to ensure that the person in the warehouse isn't also recording inventory, as we talked about in a prior chapter. Another list, sorry about that. And here's a final one, proof and security measures. It's just making sure that we've got passwords and that we've got security locks and that we have measures to come in sometimes and do a spot count. That happens frequently in a company, and that is that someone will walk in and say, okay, we're going to do a quick count of inventory to make sure it matches what's recorded in the accounting records. It's not popular with employees, but it's one of those control procedures that's extremely important. Monitoring the activities is important, and I think everybody's familiar now with how closely you have to monitor related to the issues of cybersecurity, because hackers can find ways to get into a company's information systems very quickly today. But monitoring can also include watching employees and watching the accounting system to make sure there's no problems. Some warning signs. It's always a good conversation in class, but you'll find an abrupt change in lifestyle. We are trained, I was trained as an auditor when I went into a company to analyze their financial statements, to watch employees and to see what's their lifestyle like compared to what I know that their salary is. And yes, we do actually go into that much of a close analysis. So we are trained as we're looking for fraudulent activity to see if there's an employee that exhibits a very high-end lifestyle but that doesn't make very much money. Maybe that employee makes $20,000 a year, and yet they're driving an extremely expensive car, or they live in a very expensive neighborhood. And we, lots of times as auditors, are trying to say, is there family money? Is there a spouse or a significant other that has money? Or is there a possibility that this person is trying to maintain a lifestyle by embezzling from the company? And yes, we call it professional skepticism. A lot of people find it to be a little offensive that you're always going around looking to see, but that's part of our job as an auditor. We look to see for employees that don't take vacations, that might borrow money from others, that have excessive use of drug or alcohol. They may have a drug problem and they're having to embezzle from the company. Close relationships with suppliers could mean that there's kickbacks occurring. Someone in a warehouse that has a very close relationship maybe takes vacations even with a supplier. Maybe there's a kickback coming that the guy in the warehouse will place orders from a certain vendor, and in exchange, the warehouse guy gets nice vacations with that vendor or nice meals. As much as it sounds like something laughable, it's something that everyone who's ever done an audit has uncovered at some stage. The accounting system also kicks out some warnings. Missing documents or gaps in transaction numbers, a lot of customer refunds. Let's take an example of a discount store like Walmart or Walgreens or even a grocery store. If you monitor the discounts and returns account on the accounting system and you see that it's gone really high compared to other periods, and maybe it gets really high when a certain cashier is at the register, there are lots of scams out there where cashiers will allow their friends to steal merchandise and then they'll turn around and bring it back for cash, and that's shown by an increase in the customer refund account. Some of these others you will cover probably if you ever take an auditing course. Information and communication has to do with ensuring that information about the environment and about the regulations and the compliance required is communicated with every single person in the company. These types of controls shouldn't be a secret. Every employee in the company needs to be aware of what's going on and how this process will ensure that the company has accurate financial statements. Most of the time, employees are just really frustrated by all the paperwork or by all the restrictive policies and procedures. They don't understand the purpose of them, and I think it's important that employees know and are communicated with about this information. Now, limitations. First of all, there's a human element. There is just plain and simple, there's error. People make mistakes. So a lot of times there are just key punching mistakes or just errors that happen that cause embezzlement or financial statement fraud. But there's also the cost benefit piece of it. And that just means you can't spend but so much money to ensure that your employees or that your numbers or that your customers aren't taking things or if things aren't inaccurate. So you have to be very careful about the human element, cost benefit. You also have to be careful about something called collusion. And collusion means two employees working together. And it's something on an audit that always occurs by the CPA. And say, for example, the person working in the warehouse at a grocery store is very good friends with someone that works in the accounting area. They could very easily decide together that the guy in the warehouse is going to embezzle food. Maybe they're going to take the high-end steaks and things like that for their friends every weekend, and the person in the accounting area can cover that up because they have access to the records. So collusion is another one of our limitations that we have in internal controls. So, kind of a skeptical area. A lot of people, when they first hear about internal controls, think, wow, you just really don't trust anyone. But corporate fraud accounts for billions and billions of dollars worth of problems a year. It has been said that if we could eliminate corporate fraud, the cost of just about everything that we purchased would be reduced. There's fraud in the government. There is fraud in just about every single business. And it's unfortunate, and lots of times it's rationalized. People say, well, I'm not getting paid very well, so I have every right to steal this, maybe to steal all of my printer ink for my cartridge at home for my family. It's one of those things that you will discuss if you ever take an auditing upper level course. There are also people that do nothing but work in internal controls. It's called risk advisory. There's also people that just work in the fraud area, certified fraud examiners. But it all relates to this system of internal controls. We will stop at this point for this slide, and our next slide will talk about internal controls related to cash.